welcome. Our panel is on right-sizing managed accounts, and I think we're going to go in a myriad of different directions with that theme here. Just a little bit of an intro here. Obviously, continuing to lean on hedge funds for added protection, investors increasingly are forcing managers to consider a wider variety of investment vehicles to offer greater liquidity and control as all face a more volatile investment landscape. Assets on managed account platforms grew by 23% in 2017, which is the strongest year of growth since HFM InvestHedge specifically began tracking this industry segment in 2012. And so just to be clear, that's managed account platforms. A lot of those assets would be fund of hedge fund assets, and what that probably doesn't account for would be a greater number of managed account relationships we see at a variety of pension funds directly to managers. And some of that is shifting to platforms as well. Industry research, though, suggests that the total AUM, I don't know if you guys have heard this, in managed accounts could be close to about $600 billion, or roughly 16% of the total hedge fund industry assets. So joining me here today to talk about this a little bit more are, immediately to my left here, John Fidler, Director of Alternative Investments at Commonwealth Bank and Trust Company, and you're based in Louisville.
Yes, ma'am.
Yeah. And then we have on his left, Jacob Walther, Chief Executive Officer at Blueprint Capital Advisors, which is an investment firm he founded in 2015 that allocates to emerging hedge fund managers primarily. And Jacob is based in New York.
Yes, ma'am.
And here we have also Anthony Vesta, Managing Principal, Head of Portfolio Strategy at FEG Advisors. Did I say that correctly?
FEG Investment Advisors.
Yeah, I'm getting used to that. I'm going to call you Fund Evaluation Group. You may not like that, but I will. And if I have this correct, Anthony, you're in Cincinnati, and you've been with the firm since 1997, is that right?
Correct.
Wow.
Yeah.
And then at the end here, we have John Reiners, Senior Vice President of Institutional Sales at Gemini, and you work on the solutions team for managed account platforms. Great.
Thank you.
So thanks, guys. So here we go. If I can turn the page, I'll get to some questions. So basically, over the past 10 years, I know I've written a lot about this, but we've just all seen an ever-changing marketplace for institutional investors. Can each of you maybe give us your thoughts on the landscape of managed accounts, where it's been, and how it's evolved, maybe particularly in the last few years? It seems like there's been a ramp up. I'm just opening this up to the group, so whoever wants to take that.
Sure, I'll take a
Okay.
first crack on it. We've been around for about 3 years, although my involvement in hedge funds is much longer than that. And I think for the better part of the last 10 years, managed account platforms as a concept for implementing an alternatives portfolio has faced somewhat of an uphill battle, some headwinds. Mm-hmm. And I think that that had a lot to do with what I'll call commercial stubbornness on the part of a lot of hedge fund managers and other alternative managers. But I think there are also some structural issues related to the intermediaries that control a lot of the capital flows into hedge funds. So if you're a consultant, the easiest thing for you to do is to underwrite a fund and then have all your clients invest in that fund and then on an ongoing basis monitor that fund. If you were to offer underwriting for managed account services, you'd have different pools of assets for every client, and it makes the business hard to really scale. And so you've had that sort of structural impediment to the growth. I think we've now come to a point where there's a significant issue out there that is being addressed, sort of one investor at a time, and that's the issue of fees. And the only real way to get around paying higher fees associated with a commingled vehicle is to use a managed account. I mean, most of the commingled funds have anywhere between 20 and 50 side letters with institutional investors. And it makes it hard to circumvent those MFNs in order to get to bespoke fee schedules. And so we decided that managed account platform would be a fundamental part of our business and our core value proposition, because we think we're in a lower return environment. And in order for the return to be more beneficial to the investor, we need to negotiate our own vehicles with a better alignment of interests, capped expenses, lower management fees in exchange for longer crystallization, in exchange for longer lockups, longer crystallization periods, so that we're not paying fees on a lot of unrealized gains. And so when I think about kind of how many investors are out there complaining about the fees they're paying to alternative managers, I think the landscape for managed accounts is a lot brighter perhaps than its past has been.
Okay. Anthony, would you agree with that?
Yeah, I would. I'm seeing a lot more applicability in managed accounts outside of the traditional hedge fund space. So if you go back on the managed account platforms, my first experiences with the managed account platforms were the traditional SMAs that were out there for the traditional asset managers, and then the unified managed accounts and the progression of that. Our client base is institutional, and we haven't really seen a lot of that technology been brought into the institutional landscape yet. So if you're a really large institution, you have no problem going directly to any asset manager you want to go to. But there is a big pool of small to mid-sized institutions where for being able to make smaller allocations, you don't have the option to go directly to the managers. And subsequently, that may limit the pool of asset managers that you have access to. So I think now what we're starting to see is, I've seen the managed account side, like I said, on the UMA and the SMAs. I've also seen it in the hedge fund space. But I think you're starting to see, as traditional and traditional strategies and hedge fund strategies converge, and those asset managers converge in their investment strategies, you're starting to see that technology kind of percolate upward to the institutional space. And I think it's going to offer a lot more investment options out to either the smaller investor or even into the institutional marketplace. So that's what I've seen.
One thing just to play out, and Jacob and I talked about this a little bit earlier, but from our standpoint as a provider, we're seeing technology change this as well. So go back 10 years ago, the technologies to report and integrate together just really didn't exist to make this feasible. So, you know, if we look at what we do with putting together a seamless end-to-end process to make sure that we can support the structuring, the monitoring, the reporting, and put that back in a web user interface, that keeps the cost low to do this, and then makes it scalable out in the out for the client and the consultants that work with it. So, in addition to cost reduction, which is a change that's happening, I think there's a certain state pension out east that in 2017 set out a goal to reduce investment expenses by $100 million, and they actually came up with a plan to do $240 million over 4 years, which is a success. But the point they say is, hey, we can't control the markets, but we can control reducing fees, and managed accounts really fit right into that to right-size the fees.
John, would you have anything more to add there?
Yeah, I mean, I can speak firsthand to what you're talking about in terms of costs and technology. I started at Commonwealth in Louisville about 3 years ago to build out their alternatives platform kind of from scratch. And before that, I had been at a family office for about 10 years allocating to CTAs and other hedge funds. And we'd effectively built our own platform. We had two or three people who worked in the back office reconciling and creating risk analysis, and we had software written in-house to monitor VAR and all these other risk metrics. And that was a major undertaking to go out and hire these people and build these systems and have this daily monitoring process and so forth. And in 2004, 2005, that was sort of what you had to do and the money you had to spend if you wanted to create that environment. When I started with Commonwealth in 2015, 2016, the landscape has changed where you don't need that upfront investment to get the same level of high quality reporting, transparency, et cetera. You don't need the same number of people, you don't need the same investment in systems. So the game has definitely changed with regards to it's like everything else in finance. It's become more democratized and the barrier to entry is lower.
Now, are you working with clients, primarily family offices, I'm assuming, or individuals?
So our client base is mostly high net worth folks and smaller institutions. And we have a couple commingled vehicles that we manage for them, and then in some cases we do things direct for them as well.
Is that the same, Anthony? You have probably some larger mid-tier.
Yeah, our client base is purely institutional. and
Okay.
that could be mid-tier institutions up to the larger institutions.
And Jacob?
Yeah, we're focused primarily on larger institutions.
That's what I thought. Okay.
We think that there's a significant growth opportunity in the managed account space for what we call conversions. So if you take a lot of the largest public pension funds in the US and even the corporate pension funds, they have allocations that range from $100 million to $400 million with individual managers that are sitting in commingled vehicles at very high expense ratios. And so we're trying to convince a significant portion of those that they ought to convert those assignments to a managed account with bespoke fee structures.
Well, obviously, I mean, managed accounts, and we've discussed this a little bit here and in the previous panel, I mean, they're widely used by asset owners and the managers themselves, but the reason I asked you guys about the investors you work with, I'm just kind of wondering what types of investors are best suited for managed accounts. I mean, is this for everybody? You know, what kind of asset size is there a cutoff to asset size when it comes to managed accounts? I mean, I think historically there possibly has been, but maybe now and not so much.
Yeah, I think that line is changing.
Yeah.
So even larger institutional accounts, when they want, you know, the idea behind managed accounts is customization, access to key managers, potentially bring the fees down a little bit. And when you get into an institutional portfolio, even smaller allocations can be very troublesome for institutions to get access to the right managers. So as the technology is further adapted and new applications of managed accounts, I think that you're going to see that line in terms of, you know, what size account is appropriate. I think you're going to see the line go up, and it's going to have broader and broader application to more and more larger account sizes.
Okay.
I think it's also a function of what type of strategy you're trying to execute through the managed account. So obviously, you know, level one assets, it's pretty easy to do those at smaller levels. The cost associated tends to go up when you look at doing level 2 and level 3 assets, and so you have to make a decision. You know, at some point, you know, it may be more economical, as much as I hate to say this, to go into a manager's commingled vehicle than it may be to launch a managed account if you don't have critical mass of AUM. So I think it's equally relevant to think about the strategy that you're going to try to, you know, execute through the managed account.
And not every strategy, I mean, I don't, maybe we're not supposed to say this on this panel, but I'm a big proponent of managed accounts. I've always invested via managed accounts. When, you know, it's 95% of what we do. But there certainly are some strategies that, for whatever reason, you know, don't lend themselves to that. But to get back to your original question, I think, you know, not only are they becoming more appropriate, as Tony was saying, for large groups, but I think, you know, if you look at these managed account platforms, you know, the size of investor that can access those, I mean, it's almost like any investor who's a QEP, it could potentially be appropriate for them to look at accessing, you know, certain parts of their portfolio that way. So I wouldn't go so far as to say it's like a retail product, but it's a lot closer than it was 10 years ago.
Sure. John, do you have anything more to add?
Well,
on
I think
that point?
they said it well. I mean, you know, 50 million's been a discussion point where it makes sense, but the larger the assets get, the greater the bargaining power to reduce the fees too. So it's dependent on strategy and the assets that they hold. So
I think the universe of investors, though, is evolving in terms of the sophistication level. And so you find small investors that have a high degree of sophistication in terms of their ability to pick managers. And I think on the larger end, you're seeing that as well. And so to me, the spectrum can go from a high net worth individual to a really large institution. Those that want control over, you know, developing and allocating their portfolio in the way that they see fit, and then making the changes as they change other parts of their portfolio. Just from that point of view alone, I think that managed account platforms make sense for everyone if you really want to control your allocations.
And we talked about this a little bit in our prep call too. I mean, for all of what's happened over the last 4 or 5 years specifically with technology and just greater ability to go into managed accounts, it seems like there's still maybe out there some misconceptions about managed account investing. I mean, what's been, maybe each of you could just talk a little bit more about what your experience has been in implementing managed account portfolios, and have there been instances where it just really doesn't work? And maybe you were saying, in some cases, maybe was a case to be made for commingles.
I think there's been a fair amount of focus on the investor in terms of what the benefits are to manage accounts. We found when we started our business, we had to spend some time educating the managers.
Okay.
Whenever we talked to the managers about running managed accounts, they thought for some reason they had to increase the size of their operational staff, and this was going to be, extremely complex. And what we realized is they just didn't understand the technology supporting the whole managed account infrastructure and managed account platform. So we had to spend a fair amount of time, and when they understood, they said, okay, wow, this is pretty easy for us to do, and why have we been fighting it so long? And so I would say that the misconception on the investor part has been that it costs more, and that's been put out there by people who obviously would rather see different structures used. But I think that the bigger impediment has been on the manager side, where they just don't understand what managed account platforms can bring in the way of benefits.
Yeah, I totally agree with Jacob, and I also think it comes back to the type of strategy. Certain hedge fund strategy, like managed futures, for instance, has historically always been like managed accounts are the way it's done.
Yeah.
You see lots of managers, especially early stage managers, don't even have a fund; they just have several managed accounts. If you look at long-short equity or credit or distressed or something, that's totally anathema to them. So, particularly as you get into the less liquid asset classes, and not even less liquid, because we'll come across like long-short equity managers who have the same misconception. It's just outside their realm of experience.
Yeah, and some of the things that I've seen, there are some really good investment managers out there. And when we talk about managed accounts with those, I don't know if it's perception, misconception, how that gets labeled, but there's still a great deal of concern over transparency. If you have a proprietary strategy that has been successful, managers are often very sensitive to the transparency they can provide. And then additionally, it's not just transparency, but it could be a dilution of the effectiveness of their strategy. If it gets into managed accounts, then there are concerns on, will it continue to be an effective strategy? Sometimes there could be a lack of transparency back to the managers with regards to who's owning their strategies. If they have their strategies available in managed account platforms, who has it, and what's the actual assets they have in their strategy. So there's some sensitivity to that today. I don't know if that's, I think it's probably a pretty gray area when you look at the spectrum from perception to misconception, but I think those are some real issues that the managers are facing today.
Any tales you'd like to tell out of school, John?
I had 3. They covered 2, right? So too hard, too expensive. The third would be the misconception is that only alternatives are a fit for this, and we've seen that long-only strategies can work as well. So yeah, it's just maybe it's an education process that as we all learn it and this industry learns it and grows, we'll cut through that. So.
And as we were saying, there's, by our estimates, 112 billion in these managed account platforms out there in a variety of places around the world. But obviously there's much more, and more being set up by the day. I'm just kind of wondering, do you think we've reached a level this is a level of success for the managed account space? Is there room to grow further? Could it ultimately be that the limited partnership is dead? Just throwing it out there. Whoever wants to take that.
Yeah, I don't know. I could see a coexistence of the managed account and the limited partnership. I think that the growth of the managed account industry is a testament to just how effective it can be in client relationships, and there's still a long way to go. Managed account platform, at least in my experience, it's almost like a path to least resistance. And as long as they have that, I mean, it offers affordable, effective investment strategies out to clients, and you can customize within the managed account framework. And as long as that's out there, I think that's a pretty effective tailwind to the growth of the industry. So.
Yeah, I would say 112 billion in the context of the global marketplace seems small.
Right.
I think that, to me, that represents an opportunity, right? There's a lot of institutions out there that haven't done it yet, that we have to convince to try one at a time. And I don't know a lot about the family office space, but in the institutional space, there's usually 4 or 5 bellwether institutions that once they do something, everyone follows. And so I think it's only a matter of time, and it's not 5 years or 10 years. I think it's 24 to 36 months before everyone starts to understand that managed accounts has been an effective way of managing their alternative exposures. I don't think it would hurt if we had some more volatility in the marketplace and perhaps an opportunity for alternative strategies to show some performance leadership. Because right now there's just a lot of capital just kind of sitting comfortably in whatever vehicles they're in, and there's no reason to make any changes. And so we find that sometimes when we talk to people, they don't even want to talk about their hedge fund portfolio at all, forget about structure, because you're just happy to let it sit there away from the board's attention. But when these strategies start showing leadership again and people start allocating fresh capital, I think you'll find that managed accounts will get more airtime.
So you don't feel like those bellwether few big institutions have already begun to make those moves, or do you think it's still not there?
No, I think Cal Stirs has kind of dipped its toe
Right.
in. That's really been in the last 12 to 18 months. I think Hawaii, Rhode Island, and a couple of others have really just kind of did their searches and started really doing it. So, I think you need, a New York Common, and, New Jersey's now doing it. I think you need a few more to really kind of
Critical mass.
do it effectively.
Interesting. And just kind of leave it on this note. I mean, what do you guys see as as the future of managed accounts and the continued benefits to your business related to managed accounts? What are those benefits?
Yeah, I would say it's kind of 3 things in my mind. It's access to the top managers that are out there. It's you're going to see a continued compression of fees. So it's going to make highly desirable strategies more cost effective out to the clients.
Okay.
And I think that the process that you go through when you access managed accounts, it streamlines your back office. Whether you're the asset manager or if you're a client, it streamlines, well, for lack of better words, the paperwork that's needed to be able to access all these different strategies and put them into a single portfolio. So
It is our differentiator, right? So when we go and do research on a manager, we say we want to focus on the management team, we want to focus on the strategy, and we want to be structurally agnostic. And then we want to design a structure that makes the most sense for that particular strategy. As we saw in 2008, there were strategies with asset liability mismatches. We find today, as we dig more and more underneath the hood of some of these strategies, there are reasons why it makes more sense for them to be in a managed account framework. And we think out of that process of designing a vehicle around each of our managers that we've selected, we're going to be able to demonstrate to the client that on a risk-neutral basis, in other words, the same portfolio they were getting before, we're able to generate what we call structural alpha. And in an environment where we're talking about 6% being a great year in hedge fund strategies, being able to add another 70 basis points of quote-unquote structural alpha, to us is going to be meaningful.
Yeah.
So it's our differentiator.
I still think the liquidity, it's a cliche or it's obvious, but the liquidity, at least to our investor base, which is again mostly high net worth folks, is a huge deal. Not that they're trading in and out of these funds, but to be able to know that if something, if the market's down 20% next month, they're going to be able to rebalance and put money to work somewhere else, as opposed to being in a vehicle where they're locked up or they have quarterly liquidity with 90 days notice. That's a big deal. So is the transparency. To be able to sit down with one of these people and say, I can show you more transparency in our hedge fund portfolio than I can in our long-only equity portfolio, because mutual funds only report their holdings, whatever it is, once a month, once a quarter. That's a huge deal, and for a lot of people, that's kind of an eye-opening thing. And also for us, because we do a lot in futures, the capital efficiency is a big deal. We think about fees in kind of units of fee, fee per unit of volatility, and it's very easy when you build a multi-manager portfolio. It nets down, and you have like a portfolio, and you see this with the 40-Act multi-manager funds all the time. They'll have a 4% volatility, and you're paying a 2 or 3% fee. That doesn't make much sense. So being able to target a more reasonable, more market-like volatility level is a big deal too.
John, anything to add?
We're kind of too biased, I think, just to ask me. No, it's exciting for us. It's an exciting time at the, in the space, and the assets have doubled in the last 4 years, more than doubled,
Yeah.
to 112 billion, and a lot of that came in the last 2 years. So I feel like it's just getting started.
All right. Well, we can certainly we'll take a break here, but we can certainly discuss this the cocktail hour if you guys are still around, I hope.
Absolutely.
And maybe talk about cryptocurrencies too, or maybe private equity and managed accounts. Who knows what's next? Very exciting. But join me in thanking my panelists here today.
Thanks.